Sarah, if people think we're facing a disinflationary bust, why do I want to be in energy?
I don't think that you need to rush into energy. I think that you have time, but I also think that there's a bit of complacency going on now that we've had a warm winter in Europe. And we've seen, the question of what's going to happen with China, whether or not we're going to get a recession in the U.S., that's all been weighing on commodity prices. But I think that you will have some issues as we get into the summer, if we have a very hot summer, because there is a weather component to energy. But I also think that you've got, as I've said earlier, years of underinvestment in energy and traditional energy. And I think that there are both interesting opportunities on the more traditional energy side, like a Devon, and I also think that something like a Chart Industries that plays into LNG is also a very interesting situation where it sits right now.
Sarah, do you think we are facing a disinflationary bust? Is that your underlying assumption here?
I think there's so much right now that depends on what happens with the economy. And there are so many, it's such a wide sort of probability curve right now, because it's really hard to figure out, are we completely done with this banking crisis? If so, that would be an unusual, very short version of what could go wrong when you have a massive change in interest rates. Do we have a slowdown economically across the world? Does the U.S. slow down? Does China come out of this faster? I think the U.S. is still experiencing a lot of economic prosperity on the back of 2 years of sitting at home and not doing anything. So I think that there is a very uneven recovery in this economy. So it's very difficult to parse out exactly how this goes forward. I think it's difficult, however, not to assume that some of this credit tightening that's going to come about because of the banking issues is not going to slow the economy. The question is, how slow does it get?
So, Sarah, the other question then is, where do I want to take cyclical risk? Some people are just going into tech. Lower rates, a rate cut away from another tech boom. We've all heard the same thing, Sarah. Are we underestimating the cyclicality in that sector?
I think that you had such an overreaction to higher interest rates in some of the larger tech stocks where there still is going to be growth that didn't really need to have lower interest rates in the way that people sort of expected. So I'm not sure where that goes, but I definitely think that there's growth in the tech sector. So you're going to see people going back in there, as you've already seen. I mean, the best performance so far this year has not been in the cyclical sectors or the economically sensitive sectors. It's really been in the tech sector. Even as interest rates started to go higher, there was sort of a snapback from last year because those stocks were down so much. And I think that it's more likely that the Fed pauses and turns into an abrupt cycle of cutting rates unless there's much more stress in the economy. So I don't think that we want to see the Fed cutting rates, because I don't think we want to see the stress in the economy that would force that.
This is something Wei Li of BlackRock said as well, Sarah. I'd love your response to that. Just a number of weeks ago, I'm not talking months, years, I'm talking about a couple of weeks ago, there was still this belief that the Fed put was gone, that the regime had changed. Wei Li of BlackRock said this: we don't see rate cuts this year. That's the old playbook when central banks would rush to rescue the economy as recession hit. Do you take that side of things? Does that resonate with you?
Well, I think if you just look at what happened in the last couple of weeks with the banking crisis that we had in March, the ECB hiked rates 50 basis points. The Fed did not pause completely. There was some thought about hiking 50 basis points before we got through that banking crisis. But the fact that they raised 25 basis points also says that they are really worried about inflation. And I think the historical playbook in the last decade has been, there's no inflation to worry about, so we can do whatever we need to with rates to make sure that we stimulate that economy. We're in a much different situation now, and the tensions are much stronger between, I want to cut rates because I see things, going apart in the financial world, versus I've got this inflation issue on the other hand. I think it's going to be very difficult. And I think you're also starting to see the slowdown that's coming from high rates in things like auto loan, people being accepted for auto loans and things along those lines. I think that is just starting to happen. And so it's not so easy to turn around and cut rates here with the backdrop the way it is.
Sarah, I want to finish on the market at the index level. The S&P at 1%, just north of 4K. Sarah, you can take that chart back to November. This index on the S&P 500, one way or the other, has struggled to get away from 4,000, Sarah. What is it about this level?
I mean, you could talk about the psychological level of round numbers, right? 4,000 is a flat number, and it didn't go to, it's been stuck in a range. But I think that just talks about the uncertainty that we have right now, both on the economic side and on the financial side. First, you had, rates going higher and people were piling money into bonds and treasury bonds. And then the incredible drop of treasury bonds, like look at the 2-year that went from 5% to 3.5% in basically 5 days. I think that also sort of pulls money, put money back into things like money market funds as people wait for the stock market to go higher. I think that we're just experiencing some real uncertainty on both the financial level, the economic level, and I think that that is translating into a market that really is kind of stuck in between. Are things going to get better, or are things going to get worse? And I don't think we know the outcome to that right now.
Sarah, the range on this 2-year this month, unreal.